Now, AM 650 presents It's Your Money, an up-close and personal look at your finances. Here's your host, Fred Snyder.
Up in the morning and out to school.
Okay, we're back. Live, interactive, taking your calls. We share this show with you, our listeners. For the last hour, that was a replay. You were listening to a show where I interviewed a lawyer regarding estate planning, regarding WESA and the changes in the Wills Variation Act as it affects people in British Columbia. So if you have any questions on that particular issue, because really that's estate planning, that's what we were talking about with Alfred Field. Bottom line is that that's part of your plan. That's your legacy. That's one phase of your overall financial plan. You need a proper will and all that. I want to emphasize the fact that if you're a person of high net worth, at the instant of death, you're deemed to have sold everything you own at fair market value. If you don't have a spouse to roll that over to, you're deemed to have sold everything you own at fair market value, and the tax man has to be paid. And that sometimes can be a huge problem. So you need to deal with that particular issue and much, much more. The most complicated part of a financial plan is how you pass on the assets that you've very carefully accumulated over your lifetime to your beneficiaries. That is your legacy. And really, I guess most of us are more concerned with how we live today and about a good life and not so concerned about what happens after we die, but sometimes we are. And that's what your legacy and your will and all that's all about. So if you have any questions in that particular area, give me a call, give Alfred a call, give Frida a call. Get yourself a free, no obligation, written financial plan simply by making a phone call. So we encourage you to call. The number to call is 604-737-3512. That's Frida. She's down at the office. That's for those who are shy, reluctant to talk on the air. If you want to talk live, it's area code 604-280-0650. And again, if you're calling long distance, it's 877-280-0650. Give us a call. Participate in the show. You may have some comments. You may want to share something that you've experienced financially in your lifetime that's helped you a lot, or maybe something that's hurt you a lot. You might want to tell our listeners or myself about that. Get on the line and give us a call. Remember, ladies and gentlemen, we're talking about your money and how to keep it. The most important part of that expression is how to keep it, and we don't do a very good job in that particular area. Most of us will fail financially, and most of us will fail financially because we don't have a financial plan. Not having a financial plan is planning to fail by default. Get yourself a written financial plan. If you don't have one, ask yourself, do I have one? If you don't have one, make a phone call. You get a plan free, no cost, no obligation. And I pass that offer on to anybody who's listening to this show. So log on. You can watch us live at www.am650radio.com. Click on Watch Television, and you can see it live. But I must apologize because in the last number of shows that I've done, I've been thinking that everybody's watching this on their computer. And probably 60-70% of the people listening to this show don't have the visual effects. They just have the sound. So I'm going to pretend that nobody can see what we're talking about. I'm going to paint word pictures for those who are out there listening to this show so that you can kind of visualize what's going on. So again, we take your calls. We share this show with you, our listeners. We give things away. And today, one of the things I'm going to do is a case study. And this here is an actual case study. This is a person that came into my office. It's real. And here's the situation. This here, I call this particular person Penny. It's a fictitious name. I took the name off, so I'm not giving personal data out to anybody. But I want to remind everybody, the following is a snapshot in time, measuring an existing portfolio as if it had been passively invested, which means buy and hold, over the period of time illustrated, which is a decade. The returns illustrated in the corresponding risk associated with the position is based on past performance. In no way guarantees future performance will be the same. It is merely the track record of the investments illustrated. Mutual funds are not guaranteed. Values fluctuate. Past performance may not be repeated. Information presented is believed to be accurate and comes from globeadvisor.com. And basically, we use ProStation to generate the information that we're showing you. So again, let's just go to the case study. So the case study, we're going to talk about the strategic asset allocation. The holdings table, that's what the client is invested in. A chart showing those same investments. The geographical asset allocation, how that money is distributed according to geography. The equity sector diversification, whether it's invested in growth, value, or combination styles. Style analysis. The annual returns, that's the year-over-year returns. How much did it return last year, the year before, and so on. Then the compounded returns, and then a real live picture, the growth of $10,000 invested. Then we're going to talk about risk and volatility. How much does it fluctuate? And then we're going to talk about the best and worst 12 months. So we're just looking at this particular portfolio. Consider this to be like an X-ray of your portfolio. Consider this to be an MRI. You go to the doctor, you get an MRI. You get a questionnaire. You sit down with your doctor, you fill out a questionnaire. This is an analysis of your portfolio, and everybody should get this analysis on a regular basis. And very few people that I talk to are getting this analysis of their portfolio from their current advisors. So let's look at strategic asset allocation. Strategic asset allocation is about how much of your money is invested outside of Canada. In this case, it was 6.22%. Other not enough to matter. Canadian equity is 36% of the portfolio. Cash is 42.68. Bonds is 14.56. Now, right off the bat, you don't have to be a rocket scientist to understand that too much of this money is invested in cash. 42%, almost 43%. Almost half this portfolio isn't making any money. And this person is saying, I want to get a better return on my money? It's impossible under that situation. So why so much money in cash? I would need to know that. If we look at that graphically, international equity is there. This is a good old pie chart. Canadian equity, again, 36.45. Cash, 42.68. Bonds, 14.56. So that's called the strategic asset allocation. Strategic asset allocation means how much money is invested in cash, equities, bonds, and international. What does the pie look like? Well, this pie is way too much cash, not enough money international, not enough money in bonds. This particular client was approximately 60 years of age. Needs far more money in bonds than that. You could consider the cash, put these two together, it's almost fixed income. But I look at that portfolio and I see no rhyme nor reason for it based on this particular client's circumstances. So if you can recall this, Mr. Client, I'm talking maybe about you, but you don't know who this is, okay? Understand that. So if we look at that in table form, there's the investments that were held inside that portfolio. RBC Canadian Money Market Fund, 40.49% of the portfolio. RBC Select Conservative Fund, 27.3%. Royal Bank of Canada, 32.21%. So that's 100% of the portfolio. The standard deviation, which is a measurement of risk, is 5.03. 5.03 is about halfway between no risk and moderate risk. So it's low to moderate risk, almost right in the middle. The 5-year rate of return on this portfolio is 5.97%, which is really not all that bad. The 10-year rate of return is 5.15, but the future rate of return wouldn't be as good as the past because money market funds returns have really fallen down. If you look at the 1-year return, it's 0.16 based on 1 year. So again, I showed you the pie chart. I showed you the table. That's where the money is right now. It's a real live case study. And if we look at that portfolio, we have RBC Canadian Money Market Fund, 40.49, RBC Select Conservative, 27.3, RBC Canadian, 32.21. Rate of return, again, 5 years, 5.97%. It's okay, but it's not terrific. This portfolio is not well diversified. 40% of the portfolio is sitting in cash, making no returns. 32% is in RBC stock. That's stock in the Royal Bank itself. Again, this doesn't provide adequate diversification. 27% of the portfolio is an RBC Select Conservative Fund, a single RBC fund. There is no evidence of any type of formal investment plan. Rather, it appears to be an ad hoc approach. That would be my conclusion after analyzing this portfolio, looking at that portfolio and ranking it on a scale of 1 to 10. I might give it a 3. Maybe be generous, give it a 4. But it's not well put together. So again, we look at the holdings chart-wise, which we already did. The geographical asset allocation is here. We have 85.44% of the money invested in Canada. You look at the whole thing, that's bonds and equities and everything combined. UK 1.72, Netherlands 0.56, Japan 0.96. Not enough money in the U.S., not nearly enough, 7.18. Other countries 2.67. These amounts are so small they don't mean anything. Really, U.S. and Canada is the bulk of the money. Now you're out there, you're listening to the show. What does your portfolio look like? Do you know? Do you have any idea? Can you put your investment statement down on the table in front of you, close your eyes and drop your finger on any one particular fund that you hold and say, this is why I own this particular position? This is why I'm invested in it? Because if you can't do that, you ought to be able to do that. It's time to get a second opinion. That's what we're talking about, okay? Now you can say, well, I don't care about money. I really don't. I say you'd lie about other things, okay? Because everybody cares about money. Someone once said, I've been rich and I've been poor and I'd rather be rich. So if you have a choice between rich and poor, you're going to tell me you're going to pick poor? I don't think so. And if you don't have a plan, you're probably going to end up poor. So it's time to get yourself a plan. Get on the line and give us a call. I don't like to use the word free, but it doesn't cost you anything. It's not cheap. It's expensive to put it together. You need to get yourself on the right track. You need to get yourself on the right road. Someone once said, you know, you walk a mile and then you can see further. Okay? You walk a mile and then you can see further. Think about that for a minute, okay? A lot of wisdom in that statement. So I like pictures, so I put a chart together here, and there's the amount of the portfolio that's in Canada. Now, again, I know there's people out there that don't have their computer on, but I already gave you the numbers. The money in Canada is 85% of the portfolio. That bar represents 85%. And these other little ones don't mean anything. And the U.S. is the next major holding, and it's only a pittance compared to everything else. It's 7.18. The rest don't mean anything. From a geographical point of view, this is my conclusion. From a geographical point of view, the portfolio is not well diversified. Again, the same as the first point. Too much money invested in Canada, too little invested internationally. The portfolio is betting on a strong Canadian economy and a strong Canadian dollar. If the Canadian economy is strong and the dollar is strong, this could be a good thing. However, once again, all the eggs are in one basket. And we know that grandmother told us, don't put all your eggs in one basket. Now, what do you think about this, okay? Maybe you have a question or a comment. Once again, get on the line, give us a call. We're talking about your money. We're talking about your money and how to keep it. And statistically, you're not going to end up in very good shape unless you become more proactive about how you deal with your money. Being proactive sometimes means making a phone call. Sometimes it means making an appointment. Sometimes it means having a conversation with a financial advisor, having a financial plan prepared, reviewing your account on a systematic basis. These are all important issues. So let's go one step further and let's look at equity sector diversification. So again, that's really what we're talking about here. We're talking about diversification, all the ways you can diversify. You can diversify by asset class, you can diversify geographically, and you can diversify by equity sector weightings. So 82% of this portfolio, 82%, ladies and gentlemen, listeners out there, 82%, most of the money in this portfolio is invested in financial institutions. Now, it's an RBC portfolio. I can see why it tilts in that direction. But what is the matter with investing too much money in financial institutions? Well, remember this. Financial institutions make money by borrowing money cheap and lending it expensively. And they keep the difference. So they acquire their inventory, the money they lend out, from you, the investing public, that have surplus funds. So when you buy a GIC or a term deposit, or you put your money in a savings account with a financial institution, they pay you as little interest as they possibly can. And then they turn around and they lend it out as expensively as they possibly can. They like to see people racking up their credit cards, etc., where they're getting the money they're getting their inventory at 2.5%, and they're lending it out at 18%, and they're keeping the difference. So financial institutions do extremely well when interest rates are level or declining, not when they are increasing. So if you put too much money into financial institutions, if interest rates should go up, financial institutions won't do well. And I'm not saying they will or they won't. I'm saying if interest rates increase, financial institutions don't do well. And we are closer to an increase in interest rates than we are from when interest rates started to fall. The end of this cycle is getting near. So we will no doubt see an increase in interest rates at some point in the not too distant future. So you're betting, if you believe what I just said to be true, you're betting against yourself when you put too much money into financial institutions. If you look at the rest of the portfolio, you got 3.4% in energy. You probably should have 50% of your portfolio invested in energy, in my opinion. Industrials 3%, international tech 2%, material 1.8%. Material is what you make stuff out of. Manufacturing depends on material. When you only got 1.8 committed to material, that's not good. Healthcare 1.5. Probably should have more money in healthcare. I mean, I could talk about this for an hour. I don't have that much radio time. We're 17 minutes into the show right now. Want to be able to cover off on all this stuff. But when we look at equity sector weightings, the portfolio is not well diversified. There's a chart, again, for those who can see it on their computer. There's the chart. So if you were to come and see me, you would get a printout of this second opinion on your investment portfolio, tailor-made to your set of circumstances. So again, I'm going to just read my summary or my comments back. Portfolios need to be diversified by sector. You can't have all your eggs in one basket. Geographically speaking, as we've already discussed, the portfolio is not well diversified. By the same token, when it comes to sectors, 82% of the money is invested in financial institutions. With the benefit of hindsight, this has worked out well, but is a risky position to take if interest rates escalate. From a sector point of view, portfolio, once again, is not well diversified. Too much financial, too little everything else. Get that done on your portfolio. Same thing. What does your portfolio look like? That's what's important. Now, we can diversify by investment style. So here's a style analysis. When we look at the various styles, and we look first of all at equity market capitalization, 92% of the portfolio is invested in large cap. I don't have a big problem with that. That's like big blue chip companies. Only 2% in mid cap, 6% is non-applicable. I don't know what that is, nothing in small cap. But really, we should have a better, more mid cap and more small cap at the expense of large cap to be properly diversified. When we look at equity style, because of the huge amount of money in cash, we couldn't get a reading from the computer software when we put that together. So it's just non-applicable. And then when we look at market maturity, 99% of the portfolio is invested in developed countries rather than emerging markets. I don't necessarily have a problem with that. That's lower risk. But it's still not perfectly diversified by any stretch of the imagination from a style point of view. And again, these are the same comments. I'm not going to bore you by reading those off again. When we look at annual returns, these are the annual rates of return on the portfolio. So if we look at the annual returns in 2007, we go back to then, the return was minus 0.64%, rounded off minus 1% in 07. In 08, it was minus 12%. 2 years, negative return. 09 had a great year, 20.42%. 2010, minus 0.31. 2011, 0.53. 2012, 6.88. 2013, 8.56. So some of those returns aren't bad, and some of them aren't terrific. Again, on the good old chart, there's what they look like. So we get beaten up right here. And really, when you look at returns and you look at the compound rate of return, the experience from a compounded rate, sequence of returns is extremely important. When you're looking at the overall compound rate, you want to have very positive returns in the beginning rather than negative ones like we have here, and the big returns at the start of the period. So that wouldn't have worked out well for that particular client had that client owned that portfolio for the last 10 years. And I'm not saying this particular client did. That's the track record of what the client holds today, had the client owned it back then. That's what we're talking about. So I got a video here. I'm not going to play that. I'm going to skip that. These are the compound returns. These are the most important one because this affects investor experience. So the 1 month compound is 0.16, hardly anything. 3 month return is 2.54. Year to date is 1.71. 1 year is 8.65. 3 years is 1.19. 5 years is 5.97. 10 years is 5.15. So if the client bought that portfolio as it is today, 10 years ago, would have enjoyed a return of 5.15, reasonably low risk. It wouldn't have been bad. 5 years, not bad. But 3 years ago, it's only 1.19%. Over the last three, over the last year is 8.65. They'd be happy with that. Year to date, 1.71, 3 months, and so on. Okay, let's say it's not bad. Chart-wise, there's the chart. So 5-year rate of return, pretty good. 10-year rate of return, pretty good. 3-year, not so good. 1 year, pretty good. Year to date, not so good, and so on. Those are the numbers. But this is where it really counts. If this particular client a decade ago invested $10,000 in that portfolio, what would have happened? So let's pull a chart up. There's the client's current portfolio. After about 3 years, the client would have $14,000 out of a $10,000 investment. The client would have been pretty happy with that at that point. There's what happened in the next 5 years. It fell apart right here. This is the recession of '08. It recovered up to here, looked pretty good. Then it went sideways again. It's almost back to where it was here, right here. So after about 6, 7 years, an investment of $10,000 is worth $14,000. It was worth $14,000 back here. It's still worth $14,000 right here. And then the final leg, the good periods, I illustrate them in green. At the end of the decade period, a $10,000 investment would be worth $16,627. Now, if you got a decent return over the last 10 years, you probably should have doubled your money, not increased it by 1.6, and gone through a flat period of almost 5 years of up and down roller coaster types of return. Not so good. So there's a negative period right there for 5 years. Not terrific. But really, your experience would really depend on when you get on the plane, or the train, or the car, or whatever it was. Where did you invest along that line? If you invested here, 5 years later, you're pretty unhappy. If you invested here at this point, you're pretty happy, and all of a sudden you get depressed because the market goes down. If you bought here, you think, well, this is pretty good. This is a really good advisor. I got a terrific investment. I put in $14,000, it's worth $16,000. Okay, very relatively short period. And this is why people who have investment funds don't like investment funds. They don't really have the best funds. They don't buy them at the right time, or they buy them always at the wrong time. They buy them after they've had really good performance, and then they sell them when they go down instead of buying more like they should. And they say, well, they don't work for me. The reason, ladies and gentlemen, listeners out there, that investment funds don't work for most people is that they run their portfolios emotionally. The market goes down, they think it's going to keep going down forever, and they're going to lose all their money, so they sell. The market goes up, and they say they get greedy. They think, I'm going to stay there because it's going to even go up even more. Okay, I'm going to make all kinds of money if I stay in there. That isn't the way it works. So you got to get the best funds to begin with. And what I do for my clients is that I have a selection criteria that I use to select the investments that I put into a portfolio. For example, if I want to have a top Canadian equity fund, I can tell you right now the number one Canadian equity fund that pays high dividends is RBC Canadian Equity Income Fund. Now, I hope that I'm not giving financial advice to my competitors that will start recommending that fund to all their clients, because that is a really good fund. Okay? Tremendous performance numbers, over 20% compounded annually over the last 5 years. I have some people I had a lady in my office the other day that had 500, all of her money was in that one fund. And needless to say, she's a very happy lady. So ladies and gentlemen, listeners out there, the number to call is area code 604-280-0650. Long distance, 877-280-0650. Frita's down at the office, area code 604-737-3512. Long distance, 800-661-1495. So we're talking about your money and how to keep it. How to keep it is the most important part of that expression, how to keep it. Ask yourself this question: how long have I worked? How much money have I made so far during my working career? How much of that do I have left today? And am I happy with the answers? And the chances are you are not. And the only reason or the only way that is going to change is if you become more proactive with how you deal with your money. That's what we're talking about on this show. So sequence of returns is a very, very important thing to take a look at, because the average rate of return will change dramatically. The compounded rate, I should say, will change dramatically depending on the sequence of returns. If the returns in the beginning are negative or low and high at the end, the compounded rate won't be as good as if the opposite is true. And I don't know that anybody can predict what those early rates are going to be. The only thing that we can do is use the software and the tools that exist today to select the best investment funds. So if I go into my database of investment funds and I look at that database and I use PalTrack to do that, PalTrack tells me there's over 20,000 investment funds to pick from. So if I want to find a Canadian equity fund, if I click on the equity tab, I cut that list down by about half. If I want it to be Canadian, I click Canadian and it goes down by about another half. If I want it to be one that pays dividends, I end up with 660 funds. And then if I sort those by 5-year descending order with the best performing fund at the top, it will be RBC Canadian Equity Income Fund. And that's the selection process that I use all the time. And I end up with 10 funds out of over 20,000. So they're the best of 20,000. So remember that, okay? The best, would you rather have the best of 20,000, or would you rather I put the list of 20,000 up on the wall and throw darts at it and say, there's a good one for you? Or I put the list up on the wall and I sort them by 1-year rate of return. I say, here's the best performing fund last year. We should invest in it. That's called chasing returns. Because the best fund last year, if I look at the 5-year performance for that fund, it won't be the best over 5 years. So I sort them on 5 years. And maybe I should be using 10 now, because I use 5 now. It excludes 08 and 09. Okay? So it may distort things a little bit. So maybe if I start using 10, I'm now including 08 and 09, and the best fund over 10 years would be the best fund to pick. However, if I sort those funds by 10 years, it will leave out RBC Canadian Equity Income Fund because it doesn't have a 10-year track record. It's 7 years. So it leaves it out. And I don't want to leave it out. It's a great fund. So there's a process. And if you ask me what my process is, I can tell you. I can define it. I can teach it. Okay? It's something that's replicatable. So if I want to replicate what I do, it's possible to do that. So that's the growth of $10,000 invested in the case study. I haven't come up with any solutions yet. I'm not even showing my model portfolio as a solution. But if I take and I measure that portfolio by risk and reward, and I'm using 3-year standard deviation as a measurement tool, with moderate risk being 10, and I make the comparison. Moderate risk is the blue bar, and that's 10, and standard deviation is about halfway. Okay, so the standard deviation is 5.03, moderate risk is 10. So that would be a fairly low risk fund. And if I look at the best and the worst 12 months, so you invested in that fund, the best period of time was the year ending February 2010. The return was 28.1%. Now remember, I'm talking about the portfolio the client has, not what I'm recommending, which isn't bad. 28.1% over a 1-year period ending February 2010, not bad. What's the worst year? It was minus 16.3 for the year ending January 2009. So you get some kind of a flavor as to the risk-reward trade-off in that particular portfolio. And I'm going to summarize that particular portfolio simply by saying that that particular portfolio is not diversified. It's all invested in RBC. It's mostly invested in financial institutions. The rate of return could be better. You got a lot of money in RBC stock, a lot of money in cash. I don't see any overall plan. Too many eggs in the same basket. That's the problem, okay? So if I look at that and I say, okay, let's make a quick comparison. I can go to the benchmark, I can go to the replacement portfolio, and I can make a comparison. I'm going to go to the replacement portfolio and take a look at that one right now. Now this is my model portfolio 7.5. And we can look at this in the very same light that we looked in the last one. We look at the strategic asset allocation. So here we have 5.13 in cash, not almost half the portfolio. We have 57.93% of the money in bonds. We have 21.78 of the money in Canadian equities and 14.99 in international equities, and other is 0.20. It's irrelevant. So we look at the mix, it looks like that. Mostly bonds. But we have a good ratio between Canadian equity and international equity. That's a much better mix. And if we look at the table, there's the funds. Instead of having 4 positions, we have 10. There's the percentage in each position. In dynamic energy income, 3% of the portfolio. Dynamic global infrastructure, 3%. Mackenzie US, 5%. RBC Canadian Equity Income Fund, 20%. That's the fund I already featured and talked about. RBC Global High Yield Bond Fund, 25%. Century Small Mid Cap, 3%. TD Canadian Bond Fund, 25%. 3% in TD Entertainment and Communication. 3% in TD Health Science. 10% in TD Short-Term Bonds, or Bond Fund. Rate of return on that over 5 years is 12.11%. Double what the other portfolio was. Over 10 years, 7.5. And the reason the 10-year number would be better if RBC, Canadian Equity Income Fund, had a 10-year track record. It doesn't. That's why it's blanked out there. Okay. So 5 years is what I prefer to pick. And if I look at the 5-year rates of return, 13.91, 15.53, 14.63, 21%, 10.25, 25, 4.9, almost 5%, 20.14, 22.86, and the lowest returning one is 2.37. That's TD Short-Term Bond Fund. I have 2 dynamic funds, 1 Mackenzie fund, 2 RBC funds, 1 Century fund, and 4 TD funds in that particular portfolio. So I don't have all my eggs in one basket by any stretch of the imagination. Extremely well diversified with good performance numbers. So if we look at the geographical asset allocation in that particular portfolio, we have 9.1% of the money. This is the equity side of it, 9.1 in Canada, 36.47 in the United States. If we look at it on the chart, there's the way the chart looks. So again, far more money in the United States is important. Very little money in cash. I'm going to skip some of these. I'm going to go to the annual rates of return on that portfolio. We look at the annualized rates of return. I'll start in 09. In 09 it was 26%. 2010 it was 12.47. 2011 7.11. 2012 8.48. 2013 8.94. Those are the annualized rates of return. And we look at the chart. That's what it looks like. So we have one negative year, which was 08. It was minus 9%. Okay, so it went down 9% in the recession of 08, but then the following year we had a 26% recovery, or a 26% bounce back. That, ladies and gentlemen, is a very solid portfolio. Good performance numbers. We look at the compound returns. How's that relate to compounding returns? We have over 5 years is 12.11, 3 years is 8.38, 1 year is 9.27, year to date is 4.48. 3-month rate of return is 3.36, 1 month is 0.51. Those are decent. And that's really what you want. That's what you're looking for. You're looking for good, solid performance returns. And we're getting those returns because we're dealing with the best performing funds in each category. And the one that the real acid test is the $10,000 investment. So here's what $10,000 invested over that period of time looks like. So here we have $10,000 grew to $12,000. Here we have portfolio 7.5. There's the recession. And after the recession, look at the recovery. This short period happened to everybody. Everything went down in 08. But this didn't go down very much, and it didn't stay down for very long. And that's what's important. Look at that recovery period there. Unbelievable. So $10,000 invested over that period of time, you doubled your money. Reasonably low risk. We look at risk volatility. Moderate risk is 10. The risk in this portfolio is 4.1. So it's less risky than what the client already has. Less risk, far better rate of return. Isn't that what we're all looking for? And we look at the best and the worst 12 months. So here's the best and the worst 12 months. For the year ending February 2010, the return was 31%. For November 08, the year ending November 08, it was minus 11.1. In a graph, it looks like that. So this particular period here, this negative period, was not down very much, and it didn't last very long. We have to go to the break. Don't go away.
Fred Snyder.
I want people to call the show that are genuinely interested in increasing their financial IQ so that they can become financially independent sooner and stay financially independent longer.
Fred Snyder.
You don't have a blueprint. Imagine trying to build a house without a blueprint. And how about having a blueprint for your life? What are your lifestyle goals? You need to think about your family life. What are your goals about your family life? What are your lifestyle goals when it comes to health? What are your lifestyle goals when it comes to finances, mental and spiritual? You have to set goals in all those areas, not just finances.
Fred Snyder.
Often we fail because we put too much emphasis on one area and ignore everything else. We work our butts off and we ruin our health. So life is all about balance. So you need a life plan.
Fred Snyder.
Napoleon Hill says this, wrote the book Think and Grow Rich. Anything that you can vividly imagine, ardently desire, and enthusiastically act upon will inevitably come to pass.
Fred Snyder.
My goal, my mission is to help people enhance their financial IQs by teaching them what they need to know to make better financial decisions.
Fred Snyder. Sunday mornings at 9 on AM 650. This is CISL Vancouver. All-time favorites. AM 650. Welcome back to It's Your Money on AM 650. If you have a question for Fred, call 604-280-0650. Now, back to Fred.
Okay, we're back. We're live. Remind you once again, this is an interactive show. I don't think we've had a single. I feel lonely today. I don't have a guest. I don't have any listeners calling. So you're out there, you're listening to the show. You may be a client. You may have attended a workshop. Get on the line and give us a call. Remember, we're talking about, if it isn't, it should be your favorite subject, your money, and how to keep it. How to keep it's the most important part. So we're teaching you what you need to know to make better financial decisions. So if you were to select, or maybe you want to share this with us, our listeners, okay? So you're out there, tell us how you select your investments. Who selects them for you? Do you let your stockbroker do that? Do you let your financial advisor select the investments, or do you participate in that particular procedure? I would suggest that the best way to select investment funds is to sit down with your financial advisor and do it interactively, okay? That way you understand the selection process. Just don't say, here's $250,000, invest it the best way that whatever you think is best. I'd like to say, well, I think the first thing we need to decide on is how much of that money should be invested in fixed income securities and how much in equities. And then how do we diversify the fixed income securities between long-term and short-term fixed income securities? And then how do we diversify the equities between stocks, real estate, mutual funds, that kind of thing? How do we diversify the equities between the various sectors and the investment styles? That's all the kind of stuff that we talked about. Because growing your wealth is not easy. If it was easy, everybody would just be automatically rich. You know, the simplest way to become wealthy is to don't spend everything you earn. Spend less than you earn. It becomes almost automatic. Someone once said to me, what's the best way to get out of the hole? And I said, stop digging. Okay? So if you're going backwards financially, you're probably spending more than you earn. And when you spend more than you earn, what happens? First off, you don't have any money to save and invest. Secondly, you got to borrow a lot of money to pay off the expenses that you have that you don't have the income to pay. Thirdly, you're going to increase your expenses because you've got to pay interest on the money that you borrow, so your expenses go up. You might sell some of your assets to pay your expenses. If you do that, you're reducing your net worth. You know, it isn't easy. So you need to develop a plan of some kind or another. The plan dictates this is how you manage your cash. So I'm looking here at Model Portfolio 7.5 when we talk about sector diversification. We have 3% of the money invested in energy. So when I sat down with this, when I talked to this particular client, I suggested that we invest 3% of the money in energy. Okay, this isn't what they have. Remember, this is what I'm recommending. So 3% of your money goes into energy. And how do I find the best energy fund? I remember 5-year rate of return. We sort them that way. And the fund that we recommend is the number one fund when it comes to energy. Global equity. How do we pick the best fund in that area? U.S. equity. How do we pick the best fund in that area? Canadian dividend equity. How do we pick the best fund in that area? Canadian focus small cap. 3% of the portfolio. How do we pick the best fund in that category? Global equity, 3%. Sector equity, 3%. High yield bond funds, 25%. Canadian fixed income, 25%. Canadian short-term fixed income, 10%. So I got 5 companies that provide those particular products and provide me with the best products. I have 2 RBC funds. I got 4 TD funds. I have Dynamic Fund, and I have Sentry. So that's 5 different companies. And because I'm independent, I represent everybody. I'm not part of a captive organization where I'm forced to only distribute and offer their products. I can offer just about anything that's out there. So I search for the best products. And I've said this many, many times on this show and otherwise, that everybody needs 3 things. Number 1 is the plan. And I love the Investors commercial. That's the Investors Group. They advertise the plan in capital letters like it's almost a god. Trust me, it is. If you don't have a plan, you're planning to fail. So what is your plan? So we have here the basic asset allocation sectors, the way I think they should be distributed inside an overall portfolio. And I have a CFA on staff, Peter Straka, who helps me in that particular way as well, confirms what I think is the best thing to do. So two heads are better than one. And he's a specialist in that particular area. So our business is designing portfolios that's going to provide you with less risk and better returns. I'm going to say that once again. You need a portfolio that is less risky than what you have right now and provides you with better returns. Now, someone once said, if you can't measure it, you can't plan it. So you have to be able to measure what's going on. So how do you measure the risk in your existing portfolio? I'll bet you don't know. I'll bet you the vast majority of people listening to this show don't have the foggiest idea how to measure the risk in their portfolio. In our business, it's called standard deviation, and that's a number, okay? So you need to know, what is the standard deviation of my portfolio? Now, if you have 10 different funds inside your portfolio, the standard deviation on each one of those funds is going to be different. So what is the combined standard deviation of all those securities? And it depends on the percentage that's invested in each one. It's called the weighted average. So you got to be able to do a mathematical calculation that says the standard deviation on my portfolio is, we'll say, 5, and 10 is considered to be moderate. There's the chart that we put up earlier. So here we have a standard deviation on my portfolio of 4.1, and if 10 is moderate, so on a scale of 1 to 10, that would be 4. Okay? And 10 is the highest risk, but it's not high risk. 10 is still moderate, according to standard deviation. So the risk in this portfolio is 4.1. The risk in the portfolio that we're comparing this to is 5 point something. So this is about 1 point less than what the person already has. So we have less risk. The return is double. The 5-year compounded return is double what the client's already having. So who out there listening to this show right now would not prefer, would turn thumbs down on a portfolio that's less risky than what they have now, that's more broadly diversified, that is returning double what they're currently getting? I can't understand why anybody would have any trouble making a decision to invest in that particular portfolio. And it's done properly. It's done with the proper numbers and the proper research and the proper style, and it's all part of a written plan. So if you don't have a written financial plan that covers all the bases, it's time to get one. You want to get one? Again, I remind you, there is no cost, there is no obligation. The way to get one is to call Frida. Frida is down at the office, and you can reach her right now at the office, 604-737-3512. If you're calling long distance, it's 800-661-1495. If you want to talk to myself live here on the radio, you can reach me at area code 604-280-0650, long distance 877-280-0650. Remind you once again, we're talking about your money, more importantly about your money and how to keep it. So in the first hour today, between 9 and 10, we did a replay of last week's show. Last week's show, we talked to Alfred Field, who's a lawyer, specializes in trust and estate planning. I think I'm going to be working closely with him into the future. I look for somebody that I can kind of partner up with. He knows what he's talking about for sure. And I thought we had a great show. We didn't get an overwhelming response last week. I'm not sure why. Maybe everybody's still watching the soccer or something. Maybe there's a soccer game on. I can't believe that we don't get an overwhelming response on issues like that. WESA is the Changes in the Wills Variation Act. And if you have a high net worth and you have a proper will and your will is up to date, you got to take another look at that right now, because WESA has changed the ball game. The rules are all now different. Do you know that if I were to send an email to my son telling my son that when I pass away, you can have my boat. I didn't even sign it. I just sent him an email. That can be considered part of my will. Did you know that? If my son can produce a note that's in a file someplace that says he can have my boat, that can be considered part of my will. These are big changes. They're huge changes. Remember, when you die, you're deemed to have sold everything you own at fair market value. So if you have a net worth, which is the difference between your assets and your liabilities, if you have a net worth of a couple of $1 million, and the adjusted cost base of those assets represented by your net worth is, we'll say $1 million, probably a lot less than that, but let's say it's $1 million, and you die and you don't have a surviving spouse, your estate has a capital gain of $1 million. Capital gains are 50% taxable. So that means there's tax has to be paid on $500,000. Now, the tax on $500,000 is over $200,000. So you have an unfunded future liability in your estate of a couple of $100,000. How might you deal with an issue like that? Well, there's lots of ways to deal with it. One way is called life insurance. But an even better way, if you haven't done it already, is to get yourself a written financial plan, because the written financial plan itself will address this in the section under estate planning. So there'll be a tab in that plan called estate planning, and in there it will deal with the famous deemed disposition problem. Let's talk to Tracy from Vancouver. Tracy, welcome to the program. Hi, Tracy.
You this morning.
Pardon me?
How are you this morning?
Lonely.
Good. I wanted to say, you mentioned about maybe a few minutes ago, you wondered why nobody was phoning.
Yes.
So I prompted me to pick up the phone and
thanks,
call
Tracy.
and say you've got hundreds of very loyal listeners out there that probably are very content with what you have done for them, such as I have. And that we really have no questions maybe for you.
Well, maybe we answered all the questions.
Yeah, right.
Maybe that's the problem.
What I want to ask is, can a person put their RRSP into a SEG funds and still draw on it like you would normally?
Yes.
So then your RRSP would be saved from probate tax when that time came.
The RRSP, you don't have to worry about probate, because all RRSPs, you can name a beneficiary anyway. So if you have the ability to name a beneficiary, whether it be a SEG fund or not, you've bypassed the estate, essentially.
Okay, so it's regular investments.
It's unregistered money we're talking about. Like, for example,
right, okay.
Tracy, let's say you got $100,000 in the bank.
Right.
And you die.
Right.
That $100,000 now becomes part of your taxable estate and subject to probate.
Okay. Now, the interesting thing is I was listening to Alfred this morning on the replay about the house issue, and if you're married, it looked to me as if he said, if you're married and you both own a house, that the house gets split in half if one of the partners dies. Well, is that what I heard?
It depends on the structure. It depends on if the house is owned joint with rights of survivors or joint tenants in common. It can be treated. Okay. It can be treated differently, and then there's marriage issues as well, because you live in a house and you may not be on title, but that doesn't mean that you lose your right to the house either. So the law gets a little fuzzy.
Yeah, I was going to say it looked like to me like it was somewhat fuzzy there.
Yeah.
But anyhow, it's something to talk about anyway, because I think I'm going to need to see you guys about getting some updating on my will. So I will phone Frida and get that straightened out.
Phone Frida, book an appointment, Tracy.
Yeah. And are you thinking about doing your classes again starting in the fall, or?
I'm getting a lot of pressure to do them, and I think I will. I try to do a case study a week. I've done a couple of things. I'm updating my financial planning software.
Right.
And I've done a marvelous job. I'm so proud of myself right now in that
good,
particular area.
Good. Well, I'll have to say.
But I automated it, and this has been a 20-year project.
Yeah.
And I've automated that, and I also have a library right now of case studies. This case study that I did today, I got a whole bunch of them that I put together, and they're real ones. We have all the numbers from previous ones. We just take the name off, and I use the data, and I create a PowerPoint presentation and case studies. That makes it all more practical, so that when I do a workshop or a seminar, and it's going to be about a case study. It won't be as repetitious as some of the stuff we've been doing before.
Right, so it'll be kind of a change.
It'll be a change.
Which will be good. Anyhow, I'll let you go. Have a nice weekend, and I hope all is going well for you this summer.
Okay, Tracy, I really appreciate that, and thanks for the call.
I wanted to let you know that I took another cruise. So.
Did you? Where'd you go?
Oh, we just went to Alaska.
Well, that's not just.
Just went to Alaska. I stayed pretty close to home this time.
I have to tell our listeners, Tracy, that I've advised you that you should buy a house, and you won't buy one because your goal, you want to travel.
Right.
And how much? Tell us about your travels quickly before I let you go.
Oh, okay. We went around South America, up the Amazon last year, and then over to the Mediterranean and did the Mediterranean all around almost every country that borders on the Mediterranean except for France. And we've got some plans to do the Baltic and next year. So there's. Yeah, it's been an eye opener. Traveling to me is an education as well as an eye opener to culture and geology and architecture and food and culture.
You're a retired bus driver.
Yes.
Okay. So Tracy, I gotta go. I need one more call before we have to go.
Okay. Bye.
Let's talk to Mavis. Mavis, welcome to the program.
Good morning, Fred.
Good morning, Mavis. How you doing?
Good, thank you. And you?
Oh, I'm hanging in there. Pretty good.
I enjoyed the talk by Alfred this morning. It was a great talk.
Yeah, and we didn't get a tremendous response to that radio show, and I don't know why. I listened to that show on the way out here. I thought it was a great show.
It is. It is very good.
Yeah.
I appreciate that you have him on.
Well, I was very diligent looking for a lawyer I could work with when I discovered him. So he's a good one.
Where is his office?
I frankly, I don't know. I got his card, but I don't know his office.
Oh, I see. How do you get to know him?
I got a referral from somebody that I highly respect, another lawyer.
Oh, I see.
And the test was to have him on my show.
Okay.
And he passed.
All right. Well, anyway, thank you for putting me on.
Okay, no problem. Great. And I really appreciate your call. Did you have any other questions?
Yes, in regard to TFSA,
yes.
If one don't have a spouse, but what can you put the beneficiary on?
You can name anybody you want.
Oh, I see. But you only can name one.
No, you can name several beneficiaries.
Really?
Yeah.
Okay. Thank you.
Okay, you take care.
Thank you.
Bye for now.
Have a good day.
Okay, ladies and gentlemen, thanks for participating in the show, those who did. And it was a long show to have to fly solo here, but we finally did get some calls, and they were encouraging. But again, in summary, you need a plan. You need an investment plan. You need a financial plan. You need a will plan. You need a legacy plan. You need a cash management plan. You need a retirement plan. Some of these are plans within a plan, but you need to crunch the numbers. You need to spell it out. You got to set meaningful, worthwhile financial goals. Financial planning helps you do that. So you want to take this to the next level, give Frida a call. You can reach Frida down at the office at 737-3512. If you're calling long distance, it's 800-661-1495. We have to go. We'll see you same time, same station next week, and bye for now.
If you'd like Fred to review your portfolio, call his office right now at 604-737-3512. That's 604-737-3512.